Okay, Ron, it's all you.
Okay. So you're going to let everybody in while I talk.
Correct.
Well, thank you everyone for joining us tonight. I know we were waiting for a few more people, but we're going to get started because you're all here. Oh, Catherine. Catherine will need to introduce herself also. She has a company. We're just doing a really quick introduction. Catherine, if you'd like to say just a couple of words about what you do.
Yeah, sure. Sorry, I'm a few minutes late.
That's okay.
But it's nice to meet everybody. Yeah, I'm with UpCity, which is a local Pennsylvania group about education in crypto and Web3 and trading as well. So, you know, from educating lawyers to regular people to asset managers, we basically come in and simplify crypto and tell people that, hey, crypto is a team sport. So the sea of information can only be separated by us working together. And actually an update, I just also joined an NFT project with Near Foundation. So now working on NFT as technology, as proof of ownership, and how that can be implemented to power creators and brands and their loyalty programs.
And Catherine came from LA, so she has a lot of experience in the blockchain space.
For sure. And recovering venture capitalists. So
so Catherine and her team will be featured speakers. We haven't set up the date yet, but sometime in January, February. So you'll get to learn more about her and her team. We met at a Montgomery estate planning event. So we're very excited to have her and her team with us as well. So good evening, everybody. Our agenda today is we're going to talk a little bit about the events that are going on and any announcements. Then we'll have Daniel speak and then Q&A. And then if you would like to stick around after 8 o'clock, we can have an open discussion on FTX. I know that's on everybody's mind. So if you'd like to hang out, we will talk a little bit about that. So the Princeton Blockchain and AI Group is co-organized by Bobby Mascara of Ledger Academy. She's got a wonderful program. She's been teaching for a long time. She's part of the Hyperledger organization and the Giving Chain, which is the nonprofit organization and project that we have been focusing on and won the 2020 Government Blockchain Social Impact Award. So we'll talk more about that at another time. My name is Rhonda Okamoto. I should introduce myself. I'm part of the Government Blockchain Association. I'm part of the Diversity in Blockchain Philly group. And on my day job, I help people understand legal and identity theft so that way they're able to make better decisions in their life. If you can go on to the next screen. Okay, and the Princeton, community, we've got Hyperledger Princeton, Blockchain Fundamentals, like I just explained with Bobby does through Ledger Academy, and then our group here, the Princeton Blockchain and AI Meetup, which we've been around, I think, since 2 years now. So the next event that we're going to be doing is on Thursday, December 15th, same time, 7 to 9 p.m. And this time it's going to be a holiday meetup, but a little bit more about how you need to plan for your digital assets. In other words, do your loved ones actually know what assets that you have? And the reason for that in the current financial world, when my father passed away, I had to go through 5 boxes of paperwork to see what assets that he held. And that was at a time when you actually got paper statements. But in the digital world now, no one gets statements. So we want to take a look at how we need to communicate to our loved ones what assets that we have, and crypto as well. There is no unclaimed property for crypto. So that's something we're going to be talking about, and also safety of protecting your assets off-chain.
Yeah, and then just to add, there'll be this is Bobby, there'll be an after party in the metaverse. You could either watch it on Zoom or you can try to join us in the metaverse. We'll teach you how to do that. And I'm hoping that some of the people on the call will want to show some either NFTs off or some videos of some karaoke, maybe just fun stuff like that. So I hope everybody can join us.
Okay. Oops, I had another screen up. Let me pull it up here. Okay, so come over here. I'm sorry about that. I wasn't prepared. The next one is on Friday, November 18th. And that will be Hyperledger Princeton. And then also Bobby, this is an exciting one, the December 8th. Oops, there you go. The December 8th, the ABCs of NFTs in the metaverse.
Yeah, that's going to be really exciting. I know you're familiar with that law firm.
Yeah, so one of our other friends, Go NFT, yourself, Peter will be speaking, Bobby, and Ben is from the Jersey City meetup group. And then David is from the GetHard law firm. So they're very involved with NFTs and the blockchain world. So that's going to be an exciting event. Can you go to the next screen? Okay. So today I would like to, I was going to introduce Daniel, but we can go to some of what the key terms are, because I'm not sure if everybody's familiar with the DAO. Can you go back, Bobby? I'm sorry. Okay. What is the DAO? Most of you familiar with the DAO, or would you like to go over some of the terms? I'll just go to it. The DAOs are used to make up decisions in a bottom-up management approach. There's no central authority of a DAO. Instead, it's the powers that are distributed across stakeholders who collectively cast votes, and all votes and activities through the DAO are posted on a blockchain. So that's probably the most important part of the DAO. And what is MakerDAO? MakerDAO is an organization developed technology for borrowing, saving, and a stablecoin currency on the Ethereum blockchain. I'm not going to read everything because I'm going to let Daniel talk a little bit about it, but I just wanted to have the references for all of us who may not be familiar with everything. I wasn't familiar with MakerDAO before I had met Daniel and some of the other people from Philadelphia, so that's why we had posted that key terms. So now I'm going to read a little bit about Daniel and introduce him to you before we get started. Let me come over here to, there we go. There we go. Oops. So Daniel has nearly 20 years of experience in banking and finance. His current role is a marketing president and director of specialty lending at Huntingdon Valley Bank. And that's why we're so excited. We have a Philadelphia bank in the blockchain spaces, so it's very exciting for us in Philadelphia. Krewson is building a commercial and specialty lending division, as well as leading the development of several new products, from a fully digital consumer loan product to a non-traditional commercial loan for tenant financing, as well as crypto stablecoin funding participating facility. He started his career as a commercial credit analyst with National Penn Bank, and later became a commercial lender. He then moved to a team with Valley Green Bank and spent 5 years growing the Philadelphia market. That's why we're so excited. Philly's definitely in the marketplace now. Daniel then spent a few years as a national consultant and broker, advising firms on debt and financing strategies across the country before taking a position as the Southeastern Pennsylvania Regional President for Mid-Penn Bank. Daniel has also helped directly fund, structure, or advise on more than 500 million in business and real estate loans and projects during his career. He's a Bachelor of Science in Finance from Westchester University and an MBA from Villanova University. So I would like to present Daniel Krewson. He's our speaker, and we're very excited to hear what's going on with Huntingdon Valley Bank.
Great, thanks, Rhonda. I appreciate it, and it's great to meet everybody here tonight. It's very exciting, time for us to be here. I mean, it's not every day you hear about a small community bank who's doing a crypto project, and you certainly don't hear about like a Philadelphia bank doing anything that is remotely beyond loans and deposit accounts. So it's been a really exciting year for us. So I did not have a formal presentation to present, and so what I thought I would do is really go into the the hows, the whys, what got us here, but would encourage everybody to ask questions, interrupt, make it a dialogue, because chances are everybody here probably knows more about crypto and blockchain than I do. So there's going to be an expertise that you have, that everybody here has, that maybe that I don't have. So, forgive me if I, stumble over anything, that is, more, a technical ability that's beyond my understanding. But the very first thing I think to look into is like, how did we even get here? And what did we do? So I'll just tell you the very short story about, Huntingdon Valley Bank is a fairly entrepreneurial bank. I mean, as noted in that intro, I mean, we have a lot of different projects that we work on. And so it was the ideal situation, the ideal venue for this type of project. And going back a little ways, Maker has been around for a couple of years. They're obviously a stable coin, pegged to the US dollar. And there was a mandate within the organization to go out and start investing or start building vaults. And we can get into all the terminology, but using real world assets instead of the approved basket of cryptocurrencies that they were previously using. And without, and again, I want to, somebody can interrupt me if I'm wrong about this, but, in essence, what Maker does is they mint DAI, the stable coin, and they tie it back to a vault of cryptocurrencies. And there's a percentage, advance against those cryptos. And then if you like a margin line against investment accounts, stocks and bonds and whatnot, if you go below a certain percentage, they will liquidate and then eliminate, those the DAI. So in an effort to try to diversify outside of crypto, they had this mandate to invest in real world assets. We happened to have a client who was partnered with another gentleman who was the one of the original. He wasn't a founder of MakerDAO, but he was certainly one of the folks who had helped grow it and was their head of all of their capital markets and outside sales. So he was there from the beginning and had a lot of relationships in Maker. So these two guys reached out and said to us, out of the blue, hey, would you like to partner with MakerDAO? And we said, who's MakerDAO? And really we had no idea. And they said, well, it's a stable coin. And we said, well, what's a stable coin? Truly, this is a year ago, a little over a year ago. Certainly I'd known about cryptocurrencies and what have you, but had never heard of these things, stable coins, MakerDAO, any of that sort of thing. So we ended up having to do a little research and really starting from the very, very bottom and understanding, but with like I said, in this culture of an organization that is interested in looking at new ventures and understanding that innovation is the key to success, but also that you only have to scratch the surface a little bit with blockchain, DeFi, crypto to really understand that this is where the financial system is moving. Just in the same way that the digital conversion and the internet has revolutionized banking and finance and all the other areas of finance, like blockchain and crypto and all the technology is certainly going to revolutionize it again. So all that is to say is that we had a culture that was interested in innovation, and you had Maker who was interested in investing in real world assets. And then it came down to like, well, great, we have these two organizations that want to do something. What do we do? And the figuring out how to connect the DeFi and the traditional finance took a little bit of time. There was a lot of ideas that were thrown out, At one point, we even had suggested that Maker just buy the bank, because Maker, the dollar amounts that Maker was talking about investing was started at $1 billion and went upwards. And I think at the time, we're a public company and our market capitalization was only $50 million. And so, we're like, well, just buy the bank. You want to make a big swing into traditional finance. But as everybody probably understands, that would come with a lot of regulatory oversight, and Maker certainly was not interested in that. I also do want to say, though, I don't want to speak for Maker at all, because other than having this partnership with them, they are a DAO and they have their own mission and purpose, and so we're not an employee of Maker or any of that sort. So I just want to be careful of not overstepping and saying anything for them. So after a lot of kind of back and forth, we really looked at how do we do this? Maker wants to deploy funds, and then what are some of the ways that they could help the bank? Well, because we are a small institution, we do a lot of partnerships with other financial institutions where there's something called legal lending limit, where a single loan or a single relationship in a bank is limited in size, and if there's a percentage to your capital. But for all intents and purposes, the only thing that anybody needs to know is that for a bank our size, the most we could lend to any one relationship is $8 million. So if you had a $10 million, $15 million real estate transaction or company that needed borrowing needs, we simply couldn't do that relationship. We would have to go out and find a partner. Now, banks like ourselves over time have a lot of these partners because we're small and we work together, and that's how community banking works. And it works actually really well. It's a capital delivery model that's existed for hundreds of years, and it just works really well. The problem, though, is that if just because we like something and we think it is a good relationship and a good deal or a good borrower, doesn't necessarily mean that our partner always does as well. So you end up having a portfolio of banks that you work with, and I have a point to all this in a moment. So one of the ideas that we struck on with Maker was, we said, well, what if we come up with a partnership, a participation facility, where we would generate the business, the loan relationships, what have you, and then Maker would purchase interest in those deals. It's what we do every day with other banks, and so we would just modify it slightly for Maker's purposes. But it was a very streamlined and easy to understand model. And so that idea, the participation facility, is what we ended up landing on. From there, we started preparing a MIP6, which is a Maker improvement proposal. Because Maker is a DAO, a decentralized organization, everything has to be voted on. So we spent a few months on preparing this document, which ended up being 45, 50 pages, something like that. And it really detailed every aspect of this proposed participation facility. But the general structure is that Maker would mint DAI. It would create new stablecoin. It would take that stablecoin. It would pass it off to a U.S. broker dealer who would sell it. They would convert the DAI to the dollars, fund those dollars into a U.S. trust, and then that trust would then become our partner in these participations. And because Maker, as everybody knows, there's not a big infrastructure, so everything needs to be driven by smart contracts, or at a minimum, legal real-world contracts that have very little, subjectivity to them. So we had to come up with parameters that would say, okay, well, how does Maker invest in these loans? Because what we were very keenly aware of is that this is the first of its kind. And so if there was ever going to be another facility like this, we wanted to make sure that it was set up as properly as possible on the front end to avoid, negative impacts to Huntingdon Valley Bank, negative impacts to Maker, but also just to the idea of this bridging of TradFi and DeFi. So we sat down with everybody and came up with a number of conditions and terms to try to determine, like, what could go into this portfolio, and how do we protect everybody, and really like landed on a handful of key parameters, because what we didn't want to have happen was, say, we come up with this structure, and because it is automated, anything that's automated, if the inputs are bad, you're going to have just bad data and bad assets go into it. So we didn't want ever to happen is that this go on somewhere else and somebody say, okay, well, we're going to take advantage of Maker and then offload all of our bad assets into this organization. So they had to have like good credit, good cash flow, good collateral, all the, like, I don't know if anybody has ever heard of that, there's the 5 C's of banking, which really drive all of underwriting. So we came up with these parameters. Maker, our I should say, when I say Maker at this point, we were working with the gentleman who used to work at Maker, who was advising us, and then we were also working with the Maker, which no longer exists, this group, but it was I forget the name of it now. It was like the finance core unit. So we had a couple of folks inside of Maker who, plus our advisor, plus our teams, all working together to come up with this structure. To make a long story short, we land on this final structure. We present the MIP6. We came up with minimum yield levels because, again, if you're a Maker, why would you do this if you're not going to earn some interest? Certainly, they want to diversify the asset base, and then the final piece was, how do we protect now Huntingdon Valley Bank? How do we protect our clients? Because what we never wanted to have happen. Well, let me back up. So, like, if we have a relationship with another bank, it's almost certain that other bank, when you close your loan, is going to be able to come up with their piece of the participation. So the concern with dealing with anybody in the crypto space was the volatility. I mean, if anybody has been investing in the last year or in the last 2 weeks, everybody knows that cryptocurrencies can be fairly volatile, right? So we never wanted to have a situation where there was a commitment to fund, but then Maker couldn't meet that commitment because of the fact that, like, there was, say they were having some sort of volatility, or just who knows what could happen. I mean, Maker was not affected by FTX, but you could very well imagine that there could be something similar that could have affected them. So we gave them an option. We said we had to come up with some. I'm trying to think of how to describe it, but we had to come up with like some sort of liquidity verification or liquidity covenant, and we give them an option of either pre-funding the trust account that would be the actual party to this transaction, or set up some sort of percentage coverage. So just like Maker with its vaults of say Bitcoin to DAI percentages, we kind of like reverse engineered that and came up with a percentage. Maker opted to fully fund it. It was their choice to actually fully fund it. And then they ended up, once the MIP6 went through the rounds of approvals, the rounds of voting, the technical implementation, and all the different layers, they essentially minted $100 million of DAI in 4 different tranches and funded it into an account. And I'm trying to think of when that was. So the actual deal closed in July of this year, and then they funded it within a few weeks. I think it was over like 4 weeks they had funded it, and then pretty quickly after that we actually started because what they actually are doing is they buy an interest in a credit facility. So within a few days of the initial funding, and then thereafter, we had a number of different loan sales, and it's since then we've been fine tuning it, because there was as much as you try to any attorneys on the call will know, as much as you try to like document everything perfectly on the front end, there's always like a few things you have to tweak after the fact. So that's the overall gist of it. And I threw a lot out there. But I wanted to say there was a couple of things, is that in the course of this, we encountered just honestly, we encountered compliance and regulatory issues at a couple different levels, and it became fairly evident that there was some eyes on the transaction who were watching it, who were like above our regular regulators. So as a and this is one of the things that actually Maker liked about working with Huntingdon Valley Bank versus some other real world asset providers who were pitching them on some ideas, is that, you know, we are regulated by the Federal Reserve, the FDIC, and the Pennsylvania Department of State, and because we're also a public company, we also are under the SEC. So we have, at a minimum, 4 different regulators that have provide oversight of the bank, versus, you know, say we were a private non-bank financial institution, you might have no regulators who are providing oversight. So the comfort level of having regulatory oversight was a big help for them in coming to the decision. The flip side of that, though, is that we had to go through layers and layers and layers of conversations with folks that started both, you know, at the Philadelphia level, and then eventually, you know, worked its way up all the way down to DC. Now, the interesting thing about that whole process is that you never actually get regulatory approval. You just never get regulatory denial, right? They don't ever approve or bless the transaction. They just withhold any negative comments or you know, preventing you from proceeding. Which in our world, you know, no comment is actually like good news, you know, in our space. We also, because there is a broker dealer situation where, you know, Maker, which is an offshore non-US entity. And in fact, it's really kind of fascinating because the trust, the actual partner, the participation partner is a Cayman's nonprofit whose beneficiary is the Maker protocol. So there's no people involved. I mean, it's probably the first time I've ever seen like a nonprofit entity that had a cryptocurrency protocol as its beneficiary. So going through that whole process, though, there's these things called KYC or CIP, which is the ways that, you know, regulated institutions know your customer. You know, it's how you know somebody's not committing fraud, that they're not a money launderer, they're not a terrorist, you know, who's on like an OFAC list, something like that. So the transaction actually almost fell apart because in the process of setting up these legal entities, you know, in the Caymans, and then those Cayman companies interacting with, you know, U.S. companies, the broker dealer Genesis, who's I think in the news today, there these days right now, they were having issues actually performing or completing these CIP. And this all happened at the same time that Tornado collapsed, and there was the discovery that, you know, states like North Korea had been laundering, I think it was $400-500 million through Tornado. So the whole transaction actually almost fell apart in the midst of this because the U.S. government basically stepped in and said, "Hey, this is not. We don't know, you know, who these folks are. You know, who this protocol is. Like, you know, is there money laundering happening?" And which essentially kicked us and our attorneys into you know, a full weekend of compliance gathering, which might be surprising, which is not a very exciting thing to be doing. But fortunately, we got everybody comfortable with the idea, and we're able to perform these compliance measures. The good news is that from there on out, you only have to do it once, right? You do it once and done, and then, you know, it doesn't really ever come up again unless you try to like create another new entity. The other kind of interesting thing that I think we discovered is this idea of a DAO is a little bit of a misnomer. So technically, MakerDAO is a decentralized autonomous authority. But in practicality, you have camps. You have groups of folks who own, large groups of Maker governance tokens, and those groups generally align in big big tranches of either pro real world assets, anti real world assets, pure DeFi, and then like maybe the third group is somewhere in the middle. And so a lot of the process between preparing the MIP6 and then getting that MIP6, which was the approval of this whole structure, completed, involved the Maker folks and our advisor essentially doing a lot of old-fashioned relationship building, going out, calling people, assessing temperatures and making sure that they would have the proper number of votes. And so it just was like it was just an interesting, side note that, you have the, even with a pure DeFi, DAO, you still have very much human, kind of activities and interactions and politicking and all that sort of thing. But fortunately, everybody was still on board with the transaction. And then we closed it, as I mentioned, in July. And a couple of weeks later, they actually closed. There was a $30 million transaction with SocGen, which is a French bank that they've been working on for like 2 years. And then I think since then, they may not have closed any other real world assets. Now the good news is our transaction that we did, we've closed it. I think I mentioned we have a number of loan sales. The reporting is working great. As we send them funds, because they earn interest on anything that we earn, we send them a pro rata share. Those funds are then converted. They go back through the whole process and then are converted back into DAI, and then for the benefit of anybody who is a holder of a Maker token. And that whole process has been, tested and working the other way around. So you have a full circle here of the money coming from, DAI to dollars to loan interest, to interest in loans, to then, interest from those loans back to dollars, the trust, and then back into DAI. And, it's been working pretty well so far. So I'm trying to think about, Rhonda, am I missing anything from when we had met before? Because one of the things is like, why I think I mentioned, like, why would Huntingdon Valley Bank even do this? Like, I mean, most prior to this happening, I don't think most community banks would even like consider going down this path. But it does give us like as I started to say at the beginning, both like a flexibility, because we were able to expand beyond that legal lending limit issue, but also because we know what the rules are, right? Because we know that if an investment meets the 5, 6, 7 investment criteria, that Maker will be there and will purchase the interest in those assets. So we are now able to go out and plan better, have better strategies, go out to market, in a way that you're not able to, we don't have that defined partner. And so, and for Maker's, purpose, they don't have to have, servicing departments. They don't have to have, loan originators. They don't have to have accountants. I mean, they really have all the benefit of investing in a bank without any of the infrastructure or any of the, costs, quite honestly. It's really just, they're collecting a yield for that investment themselves. So yeah, am I missing anything, Rhonda?
So Daniel, when I spoke with you in Philadelphia, you explained a little bit, there's the Maker Bank Participation Trust, but also that there's another bank that holds that certificate. Can you explain that?
Sure. So in the US, there's all sorts of different types of bank charters. This is very boring. I'm just gonna pre-warn you. So there's like savings and loans, there's mutuals, there's credit unions. We're a commercial bank, but we are a commercial bank. We don't have the trust powers, so we don't have the ability to hold assets in trust for somebody else. So there is another bank, Wilmington Savings Fund Society, WSFS, who they are the trustee. So they, as the trustee, are the ones who actually hold the dollars, the actual USD dollars that Maker funded, and that they are, when we interact with somebody, excuse me, we actually interact with WSFS itself. Interestingly enough, there's even another party, and like another third party reviewer auditor, who every time we send a file over to them, they perform a third party review as well to make sure that, we're not committing fraud. We're not, forget about fraud. We're not just making any mistakes, right? That if we say, this is, it's a, get that $10 million loan. This is a $10 million loan secured by, real estate in Philadelphia. This party will make sure that it is a $10 million loan secured by the real estate, so that Maker knows that it has, it is investing in what it is meant to be investing in. So even on the, like, if you think about, there's like a wall, right? And one side is crypto and the other side is all real world assets. On this real world side, the dollar side, you have Huntingdon Valley Bank, you have this third party auditor, you have WSFS, and then you have the actual trust itself before any of the funds goes back, to the MakerDAO protocol.
So I have a question. So does that make the loan process longer?
No, because we spend so much time trying to come up with the best ways to automate it, that like a lot of the time that was spent like on the front end to streamline that process, trying to explain to people that we spent so much time to make this seem so simple and straightforward. But it doesn't actually take that much time today. So like if we have something that we want to, like, for instance, like we were financing a marina in New Jersey, and they are acquiring 50% of that loan. That whole process, from once the bank approves it, right? There's months that lead up to that point that Maker doesn't have any involvement in, where we do all of our reviews and our analysis and the appraisals and everything that we need to do to get it approved. Once we approve it, then Maker has 5 days to do their analysis. And so by the time they do their analysis, it is ready to close. And so it'll like move forward at that point. And we try to keep it as straightforward and simple as possible when presenting it to them as well.
So, hi, this is Bobby. I have a question. So you're basically set up a reliable loan brokerage but loan brokerage system. So now that you have this reliable way to do these loans that are in excess of what you usually can, are you finding in the 6 months, and I'm guessing it's been about 6 months, that now that you have this kind of system in place, that it's easier for you guys to close these loans? And are you closing more already, or is it just still catching on?
It is still, so we tried, trying to think of like, so how to answer that question, Bobby. So anything that was existing, so we did look at selling to them some existing loans where and this was all pre-approved. I mean, it wasn't like, we were like, let's just like see what we could do. So we thought at first we would sell them interest in existing loans, because Maker was interested in getting the yield and trying to, but that ended up being a more difficult process than considering the sale as a part of the loan approval from the beginning. So it ended up that like we abandoned that idea pretty quickly, because it was actually more complex than just structuring it from the front end, knowing that a piece of that was going to be sold at the end of it to the protocol.
Interesting. So this is amazing. Like every time you said a different angle to it, it just opened a different doorway for me. So thank you for presenting this. It's really fascinating stuff. Do you know if they're looking to do more community banks, this model with more community banks, or are they still waiting to see?
Maker is Maker. They've been happy so far with with what we've been doing. But Maker itself is a interesting organization, and I think in recent months, they actually approached us very recently to now they pivoted again. I mean, this is the danger, right? Is that people getting change their minds and do things not because it had anything to do with Huntingdon Valley Bank, but it had to do with more with like internal politicking. But they pivoted to moving to like large scale treasury purchases versus doing the prior model, which was like a more diversified model of investing in a wide range of different asset classes. So but like in another 6 months, it could be something different. I just don't, you just don't know what inside the organization.
That's because the yield of the treasuries increased.
That's exactly that's exactly right. It didn't make sense to do it when treasury yields were less than a percentage point. But on the flip side, loan yields are up as well. So and one of the thresholds that we proposed from the very beginning was a minimum yield, and that was again to protect Maker from from exactly this situation right now, right? Because a less reputable institution, if we didn't put those guardrails in place, might say, hey, I have a lot of like low interest fixed rate debt. Why don't I move that off my balance sheet to Maker, and then everything that is new and higher yield will hold. So that's a no-go. And we also protected all the parties in that like you can't sell more than 50% of what you're going to hold. So each party holds 100%, holds the equal, a 50-50 if it's all 100. So that way, like if there is any upside or any downside, both Maker and the bank participated in that. And again, it was partly on this upside yield piece of it, where if we are going to make what's prime today, 7%. So if we have a loan at 7%, Maker also is getting 7%. Well, and 50-50 share. But if it goes down, then they're going to share in that. And if it goes up, they're going to share in that as well. Versus like us saying, okay, we're just going to try to move as much as we possibly can that's booked at 4% fix and get it off of our balance sheet. So it's like, and then on the flip side also is that it also incentivizes against doing, not that we would ever do a bad asset. In fact, it'd be so hard to do a bad asset, just the all the different layers you have to go through. But just say that we made a mistake, right? And something happened, and a company goes out of business. Well, also because we're holding 50% of it, the bank is incentivized to work that out, not to sell that at a discount to somebody else and then let them take the risk on it. So it also like protects both companies.
We have some questions in the chat that Rhonda can go over, but I just want to wrap up, Daniel, with my question. Where do the underwriters sit? Which company?
They sit at Huntingdon Valley Bank.
Okay, and the DAO doesn't have any of their own underwriters doing due diligence on this process. They trust the smart contracts and the information fed into that.
They correct. And the only thing I would add is, like we do a lot of lending to other lenders. And one of the sayings in the business is that you underwrite the underwriter. So in many ways, what Maker did on the front end, why the MIP6 process was so long, is that they and the community who had involvement in questions and comments, and there was rounds and rounds and rounds of questions and comments, is essentially they underwrote us, right? Mm-hmm. They analyzed Huntingdon Valley Bank and said, is this a partner based on its historical performance and perceived ongoing performance, somebody we want to proceed with? On top of that, though, there is that third-party reviewer who is also doing a test, a number of tests, to make sure that what we underwrote was underwritten properly. And then on top of that, there's all these minimum requirements in order for a loan to even be considered for sale. So there's layers and layers of protection there, and prior review and ongoing review.
Got it. Thank you.
Mm-hmm.
So Coco, if you would like to come on audio and ask your question. I know you had a couple of questions for Daniel. Would you like me to read? Go ahead.
So yes, Daniel. So one of my questions is I try to understand the whole process. So you know, DAI is created or minted by Maker, and then they created a trust, and of course after they convert the DAI into dollar, and then put in the trust, and then they loaned out to FVB through this trust to earn yield. Is this how it works?
It's pretty close to how it works. So, Maker wants to be a central bank of crypto, right? So just like the Fed is the central bank of the US, Maker would also like to have that role, but in the DeFi space. And so that's half of your question, right? I mean, you're absolutely right that that's partly what they do. Now, what does printing out of thin air or minting out of thin air mean, right? I mean, what does it mean when the U.S. government prints dollars? I mean, this is like we could get into a philosophical conversation about what that means. Now, in this case, though, in this case, that they minted the DAI, but then that DAI was immediately backed by US dollars in the trust. So you had a 1-for-1 DAI to dollar ratio between those two things. And then those dollars are then invested in loans, and then those percentages are even smaller. So you might have, and those loans are then collateralized by other assets as well. So that initial DAI is backed by the dollar, and then that dollar is then further deployed and then securitized by other assets. And so the initial DAI basically has anywhere from, at most 80% loan to value against the end collateral to 50, 30, 20%. I mean, pretty low ratios in it. And it's essentially it's mirroring the portfolio of the bank, which in the United States, commercial banks are the most conservative deployers of capital. If you think about the spectrum of capital that's distributed in the country, right? And it's primarily because we take everybody's deposits, right? Nobody wants to lose grandma and grandpa's deposits because the bank took a bunch of risky investments. So we have to be the most conservative party out there.
Yeah, and my next question is about the legislation, because the Congress is looking into regulating stable coins. So would that affect or have any impact on future transactions like this? Because I really think it's so innovative. It's very exciting.
Yeah, no, thank you. It's actually a fantastic question. I don't think there's an answer to it yet. I will say for the specific transaction that we did, MakerDAO itself could go away. It could fail and not exist no longer. And yet the trust, because it is a separate legal entity whose beneficiary is the protocol, could continue to survive and exist after that point. So no matter what happens with MakerDAO, positive or negative, going into the future, the way we structured this today, there is continuity to it. It would never grow after a certain point, and there would never be a new one. But it could, it could just never be replicated. And it's not really understood yet. And again, everybody here might have more understanding than I do, really what the implications of regulating the stable coin would be.
Sure. But once the DAI goes into the trust, so there is no, for example, blockchain related or involved.
No, once it converts to the real world, no, it's no longer blockchain.
Got it.
When it goes backwards, it is reconverted, into blockchain and then back into for the benefit of Maker.
Sure. Thank you.
Mhm.
Because we have a small group, David, if you want to unmute yourself and ask Daniel question, go ahead.
Sure. I typed a whole bunch, but no, my biggest concern is I'm actually more concerned about the assets that actually get deposited in Maker coming from the real world, and whether or not the risk that's being provided to MakerDAO. As we remember, the CDO collateralized debt obligation and the banking collapse that happened not too far back from a whole bunch of bullshit, real estate assets. Excuse my language. I'm afraid that those type of assets end up creeping into something like MakerDAO as an easy way to offload some of those assets and get a stable coin out. And actually that causing more risk to the crypto system and Maker than anything else. And because we obviously saw, if you all watched that movie, I think it was The Big Short, right? And how wonderfully they manipulated the valuations of real estate assets, on these derivative assets to float the values up to bring money in. And my biggest fear, the thing that's wonderful about crypto, and I really hate when bankers come and talk about the space, because the first thing they want to do is over leverage everything. And the wonderful thing about crypto is everything's over collateralized. And so if there is a liquidation event, everything's backed by crypto assets, and it completely takes care of itself. But now if we start importing all these, garbage assets into crypto, that actually might create some additional risk. I'm more concerned about is how is that covered and measured, so that way we don't get that junk into the space, that it actually is pretty pure at this point. And obviously, as we see, if we go look at the things like FTX, Voyager, and Celsius, those are all custodian solutions, right? That's where the problem was. It's bad information, bad assets, bad overall just dealings in the business world, where crypto has actually been pretty damn safe, especially playing in the DeFi for the last 2 years. So that's my biggest concern is having the banking coming into our space, because quite frankly, I'm fine with banks just keeping out of crypto.
So all good questions, all good concerns. Some of them I can answer, some of them I can't. I do want to make, there's a very big distinction between us, a community bank that is not doing any of the things that you just mentioned, CDOs, selling and packaging mortgages, and we don't do any of that. We take in deposits from the businesses and individuals, and we turn around and lend them out in the safest assets possible, right? I mean, so just trying to think of examples of we get criticized on the other end of the spectrum, David, where people don't think we go far enough, and that we don't, we're not aggressive enough. Well, and the response always is, we have a fiduciary responsibility to the communities we serve to not lose their money. So I would agree and with you on some part of it. If we were an investment bank or a Wall Street bank, or some institution that was just originating and selling and never holding assets, but we hold everything on our balance sheet. We don't sell it. And we're not involved in any of that sort of, any of the sort of stuff that really what tanked the financial system during the Great Recession. And I was a banker during that period, and I remember it distinctly. And it was, not something, there was a lot of unhappy people in the financial industry.
Yeah, we don't want to see it again, right?
No. And there's a lot of us who were like, well, we didn't cause that, we had nothing to do with that. And it was devastating to see your, clients go out of business because, the financial system failed because of folks that were way beyond, anything that we were ever doing. And when you say about the over leveraging, to prevent that from happening, that's why we capped it at the 50%. So what we would do with another bank, really individual investors we don't work with, but if you worked with another bank, you're always holding at least half that risk, half that asset. And in a lot of cases, what you were talking about, I'll give you a great example today. Take Twitter. There are 7 Wall Street banks, issued $13 billion of debt in order to help Elon Musk purchase Twitter. And then what they would do is they would go around and they would sell 100% of that debt to investors. The problem today is that they can't sell that debt because nobody wants to partake in it. But if they did, they would do exactly what David had indicated, which is they would push that risk off to somebody else, and then the bank wouldn't have the risk, right? But that's not at all, the space that we operate in. If that helps. Or doesn't.
No, that's good. No, and that's kind of how I would like to keep it. I can see that happening, right?
Well, that's why after the not to get like that's why after like the Great Recession, you heard about things like the Volcker rule, saying that anybody who originates a loan, they should have to hold 25% of that loan on their balance sheet, to try to prevent folks from originating bad assets and then turning around and saying, well, we're sorry, you bought a lemon car. What can we do about it? So but I mean, so I just want to make sure we don't conflate those two things, because, we are in the financial system. There's a lot. It'd be like saying all crypto actors are bad actors, right? We all know that's not true. And just like the banking system is not the same.
So Daniel, I have another question. Because you really excited to see HVB created a real use case for a stable coin. Would your bank consider using, for example, USDC as another way of getting loan, because USDC is, issued by Circle? It's another stable coin.
If it was structured in a similar way. Because what we can never do, Coco, is going back to David's point, is that we can never enter into a relationship that would risk the bank and our depositors and customers. So if Circle would do a similar structure where they would fund it, the funding was committed for whatever the relationship or the loan. Then certainly, I mean, why wouldn't we, take a look at something similar? But it would have to be a fairly similar structure. And I want to say that, keep in mind that this, when we're talking about merging, TradFi and DeFi, this is just a bridge, a Band-Aid in the middle, right? Because you have to leave DeFi, fully leave DeFi, and then, go into this, conventional entity before the banks can get involved. If we were directly connected to DeFi, the regulators would never have allowed this to happen, because there's too much possible volatility in the space. And we probably wouldn't have done it either, because again, we're always our jobs are risk managers, right? I mean, that's what we're constantly thinking about.
Do we have any other questions? You've given such a wonderful explanation of everything, Daniel, that I think people can understand. And I'm so happy that you were able to come on tonight.
Well, Daniel, I have a question.
Oh, okay, David.
The other David. What is the entity behind the dollars that you brought into this? Because as you say, you're not taking this from your community pool of investors, of depositors. So who put up the dollar conversionary amount to back the crypto?
The Maker did. So Maker minted the DAI, and then they sold the DAI through.
So they converted it to fiat and then brought it back.
They converted it to fiat, right? And then those fiat dollars were then co-invest with our dollars. So it's a that's a 50-50. And then when so again, just take that example I gave before, like say it's a $10 million deal, right? We fund 5 million, Maker through its trust funded 5 million. And then say that loan collects, 8% interest, not, probably wouldn't, but just say it did. Every month, their 50% share of that interest and the principal would go to the trust. And then Maker has the choice of either converting that back to DAI or leaving it in the trust. But once we pay them, like once we issue their the monthly payments for all the reconciliations for everything that's collected, then it's no longer, it's outside of the bank, and we have no involvement in that, and no agency anything. It's entirely up to Maker what they do with those funds.
Well, what I'm getting at is what, on the dollar side, what is covering the volatility of the crypto?
Because they funded it, because it was fully funded.
No, what I mean is,
So
okay,
Dave, DAI is a stable. DAI is backed by collateral usually, and it stays pegged to $1. So what he's saying is they put up a certain amount of collateral, and it sounds like they basically match that collateral with the loan.
so then
Am I
you as
correct?
the bank did your due diligence and you're buying into their asset.
Which is why we required it to be funded in advance. Because our concern was if it was spot funded, David, that so say they didn't fully fund that $100 million in advance, and then every time there was a request, we had to rely on DAI being minted, sold, and then funded. There's always the concern, well, what happens if that process fails? And then now we're stuck and we have a lender liability issue because we've committed to somebody that, we're going to fund their project, and then the funds aren't there. So they fully funded that in the front end.
So is this, are you, or this entity that you formed, is this different than, say, a prime trust?
I don't know what a prime trust is, to be honest with you. But it's considered a Delaware statutory trust, which I think maybe these are just different types of trusts. Because again, we're not a trustee. I'm sorry, we don't have trust powers or a trust company, and we are also, this is also important, and I'm glad you brought this up. We are not a trustee or involved in any way whatsoever with that trust. That entity is a fully independent legal entity that it only serves Maker, and then has no involvement whatsoever with Huntingdon Valley Bank, other than it lends money to Huntingdon Valley Bank, or buys interest in the loans.
And what would you gauge the success of this? Is this first 10 million tranche loan, if that is successful, you'll continue. If it blows up, so what? But because I gather that your 50%, you still have depositors that you're using those funds, right?
Right, but we would do that.
So have they agreed to, would you see that you would have to get your depositors to agree that, much like a DAO, that you are doing this with their money?
No, in fact, no, we don't, because we're not. It's actually a really great question, but because if you think about it, if you have deposits in a bank, the bank doesn't send out a letter saying, hey, these are the investments or these are the loans that we're issuing, should we issue them? What is happening, this is where the whole regulatory infrastructure comes in, is that there is this contract, functional contract, right? That between the depositors and the government, and then the employees, that there is an infrastructure in place that is taking those deposits and lending them out in a responsible manner. So ultimately, and the way we addressed the biggest concern, which was the liquidity, was the requirement of making them fully funded in advance, or a percentage of it that some sort of liquidity percentage.
Right.
And that was based off of their treasury value, I assume. I assume they borrowed their DAI based off an existing treasury that they held.
They again, I believe that they do invest in that, but again, that's between Maker and the trust company. That we don't get involved in that.
Okay, but if it's crypto and blockchain, it should be all public on chain information. So
Right, you are correct. Yes. I just want to make sure you're aware that we don't have any involvement in how that's handled.
Oh yeah, no, that's fine. No, I didn't assume you had. I assumed they just came to you with the dollars from DAI.
But yeah, they basically came to us, and I also want to say too that they really wanted us to take $1 billion, and we told them fundamentally no. Like, I mean, this is because like when David, David was talking about how could you create problems? Well, that would create a problem. If anybody came to a Huntingdon Valley Bank and said, we're going to give you $1 billion, that would create a problem because we're a $500 million bank. So how could we take double our assets and then deploy those assets? It would be irresponsible of us to do it. It'd be worse than irresponsible because you would end up introducing so much risk into the system that it would be, I couldn't even fathom doing it. So like we told them we had to scale it back. We said like that's great that you want to hand out $1 billion, but we can't take that. Like, I mean, we have to scale this back to something that is reasonable to our asset base so that we can, work within the frameworks that, we can work.
Well, when you say they took dollars, did they give you DAI or did they transfer that DAI for cash to somebody else? And put that up.
It's a good question. That was at like the Genesis level. So I'm not quite, there are definitely some factors of the conversion, the minting and the conversion that are beyond, my.
Okay, because I have to assume that somebody swapped that DAI.
They did.
Unless they burned it somehow.
Well, that's what I asked before.
So the trading company Genesis is who handled all of that.
Interesting. Is that the one that's having problems right now?
It is
Yeah.
the one that's having problems right now.
I wonder the implications of that. Interesting.
So
Well,
is HVB a community bank or is it a straight up commercial bank?
we are a community bank. I mean, because we are a commercial bank. We're both basically.
So you have a few different rules than a commercial bank, do you not?
It's driven by asset size. So because we are a commercial bank, but we are under $1 billion, we are considered a community bank. And yes, we do. We have a very different level of oversight than somebody who's a $10 billion bank. In fact, those guys have a different regulator. We have the FDIC regulates us and the Pennsylvania Department of Banking versus a larger bank, which is the OCC.
Well,
So
as you well know, the problem with banks are that, and you mentioned the Volcker rule, they were supposed to have 5% of assets in cash at all times to cover something, and of course they don't. They were winnowed.
that went away though, Dave.
What, 3% or something? But
yeah.
the point being that, in this case, if I understand you correctly, you are saying that your 50% was completely covered. It's not just that you have to keep a small percentage.
Yeah,
on deposit. You actually covered the entire 50% with a dollar to crypto evaluation at that point. Now, my point would be, and David brought up, that's interesting. What if the volatility sinks the value of DAI?
Yeah, it's going to bring an issue up with DAI because if something's happening with Genesis and if they took all that DAI and they swapped that DAI out for dollars, I mean, that's fine for the meantime. But the problem is DAI is a interest-bearing loan, and there's interest that's payable in Maker on that DAI. And the problem is, in order for them to pay off that existing loan, in case there was a listed crypto crash another 60%, and all of a sudden there was liquidation, well, they would have to obviously cover that loan. And if they're paying off that DAI, that means they would actually have to be able to purchase back that DAI to pay off that loan at some point,
right, or
pay interest with Maker. And if all of a sudden there's a liquidity issue now, because who knows what happens with all that DAI from Genesis, that might be interesting.
So does that affect your 50%?
No, but it could cause an issue on the DPEG of the die, I think, at some point.
Well, no, that's what I meant. Does that,
Right.
on the bank's part, does that cause a problem for
No,
them?
because there are triggers and fail safes built into the agreements that say that worst case scenario happened and they said we need to liquidate this whole thing, then we would essentially have to go out and then find another partner to purchase those assets at par from the trust.
And who would do that?
Let's just
Well,
say
if it's
that-
real assets, it shouldn't be a problem.
yeah. That's that would be the least of the concerns in that situation, because that situation that you just laid out didn't occur because the bank was having a problem. It occurred because Maker was having a problem, right? So like if it's the other way around, where just say all the bank's assets failed, which would be, I mean, even in the worst of the Great Recession, like community banks, all their assets weren't failing. It was other matters that were occurring. It's unlikely that situation would be happening. It's also almost equally unlikely that Maker would fully be failing. And if they were, though, then we would have to find a new partner.
Well,
those
especially if they
assets.
only took out a small portion, right? I mean,
Yeah, it's a small
doesn't sound
amount
like you
to
took
make
it. Yeah,
it.
it doesn't sound like it was
Right. And I was just going to make that point too, is that's the other concern that we had, is that this is, if you are now $1 billion of what's Maker have out, $6 billion, you're 1/6 of the die. At $100 million, you're 1/60th, or I can't do math in my head. I'm an Excel guy. But I mean, you get a sense, like there's also the scale of it, right? That like, neither party wants to be so significant to the other party that like an emergency or some event would then collapse the other entity. Neither one of us wanted that to happen. And in fact, again, we wouldn't have done it if that was the case. I really can't stress the importance of like the fiduciary responsibility that we have, and how like you cannot make decisions that would impact the entire organization without layers and layers and layers of approval.
So I'm curious, does this, in doing this, have you got the interest of other larger banks, and are they watching this to see if it were to work?
Yes.
Are they thinking of similar?
I could just interrupt and just say yes. It was after the news hit. I bet you a dozen, maybe more banks reached out and basically said, how can we get access to this? But it was also the same time frame that like Maker, because they had so much internal politicking, and they were burning money in these different core units. Maker had its own internal restructuring that like moved them away from these smaller transactions, and then wanting to do just larger tranches of treasuries and things like that. So even if like 100 banks were interested, I don't think that there was an option. Now I can tell you two things. One is that there's a lot of people who are trying to create now similar structures, but not necessarily with MakerDAO, but with other stable coins or other cryptocurrencies. So I think that you're seeing some replication of this model in other ways, and it'll probably pop up again. I also think on the banking side that like the US government, this is my gut feeling on this, not do not, I know this is being recorded, but like, don't quote me on this, but just from our interactions with the regulators, I think they are also trying to see if this model works, because they're trying to figure out how do we regulate cryptocurrencies. And is it a banking thing? Is it an SEC thing? Is it a new agency thing? So there's also like, them watching to make sure, see how it's working. And trust me, they are asking us questions and getting reporting, and they're very involved in seeing how this is working.
Well, I think it's a liquidity issue, really. But I'm surprised that Jamie Dimon wasn't first to jump on this.
Well, I think that they're trying to create their own. I mean, also like going back to the original, kind of comments, from David. What is Jamie? Is he JP Morgan Chase, right? I mean, you're talking. So they probably have. I don't know. So we could look this up quickly. $1 trillion, 2 trillion of assets. We have a $500 million. I mean, the scale and differential between what JP Morgan is doing and what we do and all of community banks do is so vastly different that like there's you can't. It's almost like impossible to compare that. It's like comparing a pebble to the earth. Like and chances are they don't need to find a partner because they are money center institutions and they will just create their own cryptocurrency.
Well,
Yeah,
he's
I see a
actually
lot of
after that.
innovation comes from smaller banks. For example, Signature Bank, after adopting CNET, their asset under management just exploding, grows so fast, and so more and more commercial banks like at this smaller size, they try to catch up. So this is the most exciting space actually in smaller banks,
Yep.
not JP Morgan.
Yeah.
Yeah, as I mentioned in a comment, it's very similar as, we've seen thus far in Silicon Valley and tech and startups and corporate innovation. Once you're a big enough ship, it's harder to pivot, it's harder to change. There's so much overlapping issues and layers and bureaucracy and reporting, you name it. So it's much easier for them to, hey, can we just watch as a hawk what's going to happen on a smaller scale, because it's easier to repeat that success at larger scale versus fail at that larger scale. So it's very interesting because I've been having conversations with Silicon Valley Bank, which has always been kind of, I at least I usually deal with their like venture arms and startup arms. So they're always, dreamers and doers versus, the traditional part of banking. But even they are kind of sitting on the sideline and interviewing their customers, asking, are you in crypto? Do you have any crypto assets as a business? You say yes. Oh God, they're like, what is it being used for? Is it client facing? Is it not? What about this? What about that? And then, I'll pop a question being like, hey, others are actually moving into the space and blending your crypto and fiat businesses, right? In terms of managing your asset, your cash flows. Silence. They're like, we're not even thinking about it. It's just brainstorming stage.
Well, and just like this may not make me popular, but just like we're talking about managing risk and all that. Like we would probably we did this, but we probably would not lend to a crypto company, right? we would we would say, well, that's too risky for us to deploy our funds to, and so so there's some irony there in that, because of the risk inherent in it, that somebody who is a crypto servicer today is probably a higher risk business and should probably be with a match funded with a higher risk sort of agency, somebody who's doing venture fund, because those people have much more upside potential. I always tell people, you have to keep in mind with a bank, our upside is interest, the interest rate. That's it. But our downside is losing everything. So we have to be conservative because we're like everybody here who owns a small business, your upside is the equity and the growth of the business. The most the bank is ever going to make is the interest on that loan, period. So it doesn't behoove us to take too much risk because there's no reward to it.
Well, isn't there, correct me if I'm wrong, but US banks, large banks are prohibited from doing anything with crypto, are they not? Or is that just a bank to bank decision? Because no bank I know of will deal with crypto.
It depends on what you mean by that. So just take the custodian part of it, right? Because we can't custodial, we can't hold custody, thank you. Since we can't custody the crypto assets, how would we lend against those assets, right? How would we do anything with those assets? Because they don't, from the bank's perspective, they don't exist. Now you could probably like, just to play the devil's advocate, just like we aren't a custody now for Apple stock, we could have an arrangement with Wells Fargo where we could lean their, the stock that they are holding in, Wells Fargo advisors. So there are ways around it. But the thing is that who is custodying crypto assets in a way that the banks are comfortable with, leaning those assets. And then once you get comfortable with that, how do you value those assets to arrive at a number that makes sense to lend against those assets? So it's just like there's no agreement and there's no regulation about this at all right now, David. But there's just a general, like, as an underwriter, as an analyst, and my background, well, it wouldn't make sense from a risk perspective to go down that path as a bank.
Yeah.
And I'm sorry if I'm jumping in like outside my line, but just had a lot of amazing stories with banks and crypto in the past, maybe 4 to 5 years. But yes, it's basically on a very high level to answer that question. It's up to a bank and it's up to the local regulation that they're under, which in the US could fall under federal or state law. It really depends. Because, for example, back in, I think it was 2018, we were running a tokenization project that was working with New York Stock Exchange, for example, and we were tokenizing one-to-one stocks that are being traded on New York Stock Exchange to enable 24/7 trading. One of the biggest clients. So one angle at the same time happening, us as an entity that is doing business in fintech. It's a fintech SaaS product, right? Happens to be on blockchain. We had continuous issues. I think within a year, we switched 3 banks because they kept closing or freezing our accounts. Not because there were issues with liquidity, not because we were holding crypto, we were holding millions of dollars of funding as a startup, but because whenever their compliance will get to auditing or reviewing you as a client, they'll see the word crypto on your website and automatically you're in a red flag, get the hell out, go do whatever you want. It was a pain, I remember. But then at the same time as this is happening, that's what's happening in Europe. Well, it was Western Europe, Northern Europe, Eastern Europe was actually opening up, and America. But our biggest client to launch this product, so tokenized stocks, was Japanese main bank, which got a green light from the government. So it's very kind of all over the place. It's kind of, I think, narrow. I think it's evening out a little bit right now, but not sure. But yeah.
There's some progress recently. Sorry to cut in. There are 3 trust banks which got the license from OCC, Anchorage, Protego Trust, and Pasos. So they are able to handle crypto lending, custody, etc. Some of them, they're still conditional. And then one bank, NY Mellon, it just got the approval to custody crypto assets, which is a huge, big news.
Yeah. And those banks that you mentioned are all big banks, right? And so theoretically, they have a very wide diversification of assets and risk. And so they could probably take on more risk like this and not worry about, and they'll manage ratios of that and not worry about it creating problems throughout the rest of the institution, right? So if we did that, we're so small, that like just as we're talking about, we don't want to you'll have a bad asset. So like it is more prudent for us to shy away from doing something like that because it would just have too much of a negative impact, on the institution. But if you have $1 trillion bank or a $500 billion bank, and they're doing $100 million a year in crypto, lending, that's nothing to those folks. I mean, you're talking like a drop in the bucket. And I just want to say the other thing too is that, like, I forget there was a bank in New York who just recently like exited crypto because we actually picked up some depository clients from it, because people saw us with the MakerDAO. The other thing that happens too, and I'll just give you the example, and this is just as an insider, say the bank has a lot of, just say you're a regular bank and you have a lot of loans to, restaurants, and then a couple of those restaurants fail. Chances are, no matter how good the next restaurant client is, the bank's not going to do that deal. So you have, but what probably happened in a lot of these situations is that they had crypto loans and some of those businesses failed. And then the bank made a risk decision and said, we're no longer going to go down this path because we have too many losses in this area. And so once the bank makes that decision, like, it's really difficult to change the institutional culture back to what it was before. And this happens across all industries, but particularly in emerging industries. So until like everybody understands what the risks are, the fundamentals are, how to underwrite it, and how to like do that as safely as possible, you're not going to like really see widespread adoption of it.
So what other industries do you feel are kind of forbidden for Huntingdon Valley?
For like your traditional ones, right? Like we don't, restaurants for one thing, sin businesses, anything that like really is, alcohol related,